Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two pioneering tech stocks to consider buying now and possibly holding for a really long time. And those two are Uber and Amazon. So they were both pioneers of their various industries and now are more established firms that are certainly sitting at nice entry points and are both Zacks ranked number one strong buy stocks at the moment. But before we get into those stocks and a little bit of the market, I want to say remember to subscribe and leave a review wherever you listen to our podcast, and make sure to check out our Zacks.com/promo page for a look at some of our service portfolios and more. So before we jump into Uber and Amazon, I quickly just want to go over the market real fast since it's been pretty heavy selling this week. So stocks fell again on Thursday with the S&P 500 down about 0.8% and the NASDAQ down about 0.2% or 1.2%, excuse me. That marked the third straight day of selling after the bulls attempted to wrestle back control of the market on Monday. Stocks were also down again early morning trading on Friday, but we did start to see some buyers step in. As of this recording, that stocks were still down, but it looked a lot better than it did at the open. So August fall, though, has obviously been spurred by kind of a mixture of profit taking, which was always going to happen after that massive rally, and then a recalibration on the inflation outlook. So the July Fed minutes from earlier in the week, coupled with continued signs of a really strong U.S. economy, which included those retail sales figures that were out earlier this week, showcased that there's going to be more pressure on Jay Powell and the Fed to keep their core rate higher for possibly longer to help cool prices and, most of all, prevent inflation from rebounding. So 10-year U.S. Treasuries are surging to new 52-week highs and are at their highest levels since before the financial crisis. The NASDAQ and the S&P 500 are below their 50-day moving averages, with the benchmark down around 4% in August and the NASDAQ down over 7%. This was as of yesterday, so nothing official as we're recording this Friday morning for where we are at the moment. Obviously, the selling, though, is not fun in the moment, but the downturn was certainly needed to kind of shake some of the froth off the top of this massive rally, because the higher up you get without any pullback, the more likely you're going to have a massive crash later on. So the NASDAQ's now near oversold RSI levels for the first time since late December, when the rally really began, and then the S&P 500 sitting at RSI levels that last hit in early March before taking off on its current run. Obviously, it's still up. It's been up for the year as well, but it had a big pullback earlier in the year as well. So overall, the pullback is setting up possibly nice entry point. And then longer term investors, though, shouldn't be too worried about trying to time things exactly, since if you were trying to time things, maybe you didn't even have many stocks you were holding at the beginning of the year, because everyone thought 2023 was going to be bad at the beginning of the year. So never try to get into the timing game too much. Obviously, there could be more selling and volatility in the near term, but the Fed is still near the tail end of its tightening cycle, and the earnings outlook for 2024 and 2025 are really robust. So those are the two things that drove the rally, and those are still in place. So we should be in a good position to see continuation of the stock market climbing, at least in the back half of the year or into the next year, if those two things remain on solid ground in terms of the Fed eventually ending its tightening efforts and earnings outlook holding up. So with that in mind, we're taking a look at two of these Zacks ranked number one strong buy tech pioneers. And the first one we're looking at is Uber. It's actually Uber Technologies is their full name, but that trades under the ticker Uber, which is UBER. So its shares have soared nearly 80% in 2023, and the ride-hailing firm in early August reported GAAP operating profit for the first time in history, and Wall Street has really celebrated its ability to expand its ride-hailing and delivery business while also focusing on the bottom line. So it crushed our Q2 earnings estimates on August 1st and boosted its guidance as ridership booms and delivery continues to hum along. It's also experimenting with some new revenue streams as well. So let's kind of quickly look into what they did in the most recent quarter and then look ahead. So Uber posted adjusted quarterly earnings of 18 cents per share to blow away our estimate that called for a loss of 1 cent. It also crucially posted GAAP operating profits for the first time in Uber's history. The company reported $394 million in profit in Q2 versus a loss of $2.6 billion in the year ago period, and an operating income of $362 million versus a loss of $13 million in the second quarter of 2022. So that's great to see. The company also had over $1 billion in quarterly free cash flow. Revenue climbed 14% year over year. Its gross bookings were up 16%. The ride-hailing business, so that's they call it mobility. Its gross bookings were up 25%, and delivery was up 12%, with trips up about 22%. So business is back to its pre-pandemic levels. It's booming again, and now that people are living their pre-pandemic lives, it's great to see that they're still getting Ubers to go places, but they're also still buying a lot of delivery options as well. So those two core businesses are showing that they're still really popular with these higher income consumers who are less impacted, say, by lingering inflation, or more just excited to live their life like they were before. So it is also worth noting that these two segments are helping really offset some weakness in their freight business, which was down 30% year over year in bookings, but it was only 4% of their business. So Wall Street's kind of discounting that for now. And then if it ever comes back in the near future, it'll be just an added bonus. And its monthly active platform customers climbed 12% year over year and 5% quarter over quarter to 137 million. So that's great to see for Uber's business. So looking ahead, we're calling for Uber's revenue to jump 17% in 2023 and then another 18% in 2024 to over 44 billion versus just 32 billion last year. And its mobility segment is expected to see its gross bookings climb 25% in 2023, with delivery set to jump another 13% as well. And then Zaxstat is calling for its monthly active platform customers to climb all the way to 146 million, so up 11% year over year, with trips expected to grow by 21%. So just really strong business for Uber amid all of the wider concerns about an economic slowdown. And then on top of that, the company is expected to swing from an adjusted loss of $4.65 per share to 42 cents per share of positive earnings, and then go all the way up to $1.05 per share in 2024. And we should note that its consensus estimates have surged since its Q2 release, with its FY 2023 figure up 500% and its 2024 figure now 25% higher. And those earnings revisions activities help it grab that Zacks number one strong buy at the moment. So obviously they're focused definitely on the here and now, which are those core businesses we mentioned. They were able to use the last several years to buy up some of their delivery peers to help boost their business. And they're rolling out more advertisements across the Uber app and Uber Eats to help monetize that growing customer base for both ride hailing and delivery. And they also, though, are focusing on growing their market share, which they've done really well against their rival Lyft. So that's all good signs. So amid all of this, though, there still are remaining focus on a possible future where fleets of autonomous vehicles drive people around cities and deliver food and transport goods. So they're focused on the here and now while also preparing for the future. So Wall Street's like this mix of the company really focusing on the bottom line and profits and cutting costs and being very diligent about all of that and disciplined in their spending, while also still remaining focused on this possible more sci-fi looking future where they don't even have to pay drivers or anything like that. So they've still landed partnerships with various companies to think about that. So just worth thinking about that as a longer term outlook for the company as well. And then in terms of price and valuation, Uber is up around 7% since its May 2019 IPO, which now seems like 1,000 years ago. And Zacks, that's versus Zacks tech sector's roughly 75% gain in the S&P 500, 60% climb. So obviously Uber has underperformed. Uber shares have climbed roughly 35% during the past 12 months to top the benchmark, and Lyft, which is down about 35%. And as we mentioned off the top, Uber stock is up about 80% in 2023 to blow away the S&P 500 and Lyft as well. It hit fresh 52-week highs the day before it reported its Q2 results. So it obviously experienced some post-earnings profit taking, as a lot of these big tech names who have been run up really high so far this year did. So it's now trading around 30% below its 2021 records and about 10% below its recent highs at around $44 per share. It's also still trading right around its 50-day moving average, trying to bounce back there. just a little bit below and about 31% below its average Zacks price target. And then in terms of valuation, it trades at a 65% discount to its own highs at 2.2 times forward sales and 43% below the Zacks tech sector. And then in terms of its PEG ratio, which factors in its bottom line growth, it's sitting at 1.2 versus tech's. The Zacks tech sector is 2.0. So really solid value there as well with that booming growth outlook on the bottom line. So long-term investors might want to consider Uber as it proves it can thrive and grow in markets that are really key to the economy at the moment and become profitable at the same time. And Wall Street's really high in the stock with 27 of the 33 brokerage recommendations that Zacks has coming in at strong buys. And Uber's recent fall has taken it from overbought RSI levels to closer to neutral. So that's a look at Uber, and now we're going to look at another one of these pioneers that's now an established giant that no one really thinks of as a pioneer anymore. But that's Amazon. It remains the titan of e-commerce and of cloud computing. And the stock looks like it's still sitting at a nice spot for longer-term buyers to consider, even if there's more volatility in the near term. So if we look back, Jeff Bezos stepped down as CEO in the summer of 2021, which once again also seems like really a long time ago. And the new CEO, Andy Jassy, has since been attempting to pull back on the massive spending as their growth slows and just normalizes. So they've really been focused on the bottom line and cutting costs and becoming as efficient as ever instead of focusing only on breakneck expansion. Which has happened to a lot of tech companies. And I think it's a good thing. Obviously, this is a new market and money's not free anymore. So Amazon and all of these companies, Uber included and Meta, have been focusing on the bottom line, and Wall Street's now rewarding them for those situations turning out to be advantageous in the long run to actually focus on cutting costs and being a more functional business that's not only focused on growth over everything else. So they had been managing to kind of defy the law of large numbers for a long time. They were posting revenue growth or averaging revenue growth about 28% annually for a 5-year period ending in 2021. So all this growth through 2021, which was beating Apple and Microsoft and Google, but growing at even half that rate over the next 5 years would require the company to be adding about $100 billion to the top line every year. So that's just becoming more and more difficult. With that said, though, they still posted 22% growth in 2021, but then they came down to just 9% in 2022, which was kind of the reason why the stock had to be recalibrated. It was no longer this massive growth business. That said, most recently, the company crushed our estimates on August 3rd, blowing by our adjusted earnings estimates by 85%. This marked the third straight huge bottom line beat and helped prove that its cost cutting is working. Plus, its overall revenue for the second quarter climbed by nearly 11% to 134 billion, which also beat expectations. Its cloud growth, though, continued to slow, but that was affecting many other companies, including Microsoft, as enterprise businesses are cutting back on spending amid some economic slowdown. But they're still the largest player, so as of Q2, they were the biggest cloud company by far, about 32% of the market share. This is above above Microsoft's 22% and Google's 11%. And then all the other players are taking up a much smaller part of that. So Amazon's still the biggest cloud player. And then it's also still by far the biggest player in the retail or e-commerce retail, above Walmart and everybody else. So two of these major businesses for the economy that are never going to go out of style at this point, just because they're too entrenched. Amazon is still the dominant player. So that is kind of a sales pitch to Wall Street on its own. Looking ahead, Zacks estimates are calling for the company to do another 11% growth on the bottom line this year, and then a 13% growth next year, to get all the way up to $642 billion. So with this said, they're expected to add about $60 billion to the top line this year alone, and then another nearly $70 billion to the top line in 2024. And then on the bottom line, we're calling for 204% growth from 71 cents per share to $2.16 per share, and then another 34% growth in 2024. So that bottom line growth is impressive as well. And then since its report, it's seen its consensus estimates trend way higher. Its FY 2023 estimates up 38%, with 2024 up another 22%. And its most accurate and most recent estimates have been coming in above estimates as well. It lands a Zacks ranked number one strong buy at the moment because of those. And its industry is also in the top 30% of over 250 Zacks industries at the moment, which is certainly a good sign. And then of the 39 brokerage recommendations that we have for the stock, 34 are coming in at strong buys. So Wall Street's still really high on Amazon. It's currently sitting 22% below its average Zacks price target. And then just kind of jumping out to look at the stock price movement and valuation level before we leave. Amazon shares are up around 820% in the last decade. This below buys the Nasdaq's 260%, yet Amazon is still down 18% in the last 3 years. This is versus the Nasdaq's 20% climb. In fact, it's still trading nearly 30% from its peaks, despite charging nearly 60% higher in 2023. It's currently trading right in between its 21-day and 50-day moving averages, and its RSI levels are now below neutral. So it's had a pullback along with a lot of other, or most of the market in general, but certainly a lot of these tech players after that big rally in 2023. And it's currently trading at 60% value versus its highs at 52 times forward 12-month earnings. So still pretty pricey if you're just looking at forward earnings. But if you go to its PEG ratio, which is factoring in its longer-term growth outlook on the bottom line, it's at 1.5 versus the tech sector's 1.9. And this is also 38% value versus its 5-year median and 75% value versus its peaks. So sitting at a nice level as well. And as I mentioned, these are both pioneers. And with Amazon, they're still the biggest player in cloud computing, e-commerce. They also have entertainment business and just tons of other operations, and they're now focused on the bottom line more than ever, and they're going to be a part of millions of people's lives for the foreseeable future. So certainly worth considering both Uber and Amazon as longer term investments at the moment amid this August market pullback. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.